Okay, welcome to Building a Startup Budget. We have one of our very own Boston Score mentors, Michael Sandman. He's given this presentation for us before, and he does a very good job in explaining everything. And so I think your having the next hour is going to be well spent. But as we get started, in case you are not familiar with Score, we want to tell you a little bit about ourselves. Our goal and focus is sharing information with the small business community, and we do that in a couple different ways. One is through the website, score.org. You'll find lots of templates and resources, recorded webinars, articles, all kinds of information that you can look through and learn from. We share the information through our workshops and webinars. We advertise those through our newsletter. They're also listed on our website and on our social media links as well. I think the most important thing that SCORE does, however, is the mentoring. And our mentors are volunteers that come to us with a lot of different experiences and knowledge and things they've learned from their successes and failures throughout their careers, to share and with you so that you can learn from them. We work with folks that are in all stages of the game, from trying to decide if small business is right for them, if those that are in the planning phase, and those that are already in business. And they come to us for about every topic that you can even imagine. So a first session, if you've never done it before, is going to last probably about 45 minutes on average. They're going to want to know what your goals are, what your challenges are, and they will help work on coming up with a plan so you can achieve those goals and overcome those challenges. The nice thing about SCORE is that our mentors do work as a team. You might be meeting with one person, but if there's something they can't help you with, they're going to reach back to the group and bring in others that have different experience from them to give you even more and better information. Getting a mentor is very easy. You go to the score.org website, there's a blue box. You're going to put your zip code in, and that'll match you to the chapter that's nearest you. Then they're going to ask you a couple of questions, and that information will be used to help match you to the right mentor to assist you. We do anticipate a pretty nice group with us today, so we are going to try and use Q&A as much as possible, because that really allows me to not lose track of the questions that are submitted. So if you can put questions for our presenter into Q&A, that is very helpful to me, because chat can kind of get rolling sometimes, and then I can lose track of things. Anything that isn't directed toward the presenter can go in chat, but if you can really focus on keeping those in Q&A, that would be great. We are recording today, and it'll take about 24 to 48 hours for it to post, but it will post to the score.org/Boston website. You're going to look under, as from the graphic on the screen, you're going to look under local workshops on the blue bar, and you'll find previously recorded webinars, and it will be posted there. So I'm going to go ahead and pull down my share. Also throughout, I will be putting some links into chat to some of the templates that Mike will be bringing out. So that'll be a good information for you as well. So watch for that. Okay, Mike, it's all yours.
Okay, great. So thanks very much for joining us. This is building a startup budget, and it's based on a lot of work that I've done as a mentor, helping clients figure out what they need, how much money they need in order to get started in a business. And we've put together something that is a business that is a little bit more complex than some people might start up with, but other people might, in fact, have all of these same issues. So if there's something here that doesn't apply to you, that's great. Okay, you've got a somewhat simpler situation. If all of it does, then we're certainly in the right place. I've had a couple of careers, one in manufacturing materials for composites, and the second was a management consultant, focused on competitive strategy. And I've been with SCORE since 2015, and all of the stuff that you're about to see has been put together since then as a result of that, the experience that I've had with SCORE Boston. And as Teresa mentioned, mentoring is free. It's confidential. So for now, we're doing, well, we're actually back to in-person uh, consultations as well, and video, phone, email, whatever. You can meet with a mentor as often as you like, and there's no limit. And there are a lot of volunteers, 10,000 nationally. So let's get started with this. Um, I want to first start with the definition. Okay, so let's start with money. Revenue or sales is what customers or clients pay. And sometimes people get a little bit concerned that, is sales my profit, or what are expenses and what is profit anyway? So let's just define these things so that we understand what we're talking about here. Revenue or sales is the net revenue or sales is what's left after returns or allowances. It's what comes in the door. And that's perhaps the simplest way to remember what revenue or sales, they're almost interchangeable, not quite, but close enough for our purposes. That's what comes in the door. Expenses or costs are what you pay to run the business. That's what goes out the door. Startup costs are really an important part, especially now we're building a startup budget. We're going to talk about equipment, build out, legal expenses, and so forth. There are fixed expenses, the rent, web hosting, insurance, telephone. They're called fixed because they continue whether revenue goes up or down. And some of you won't have rent, some of you will. Some of you will have interest payments that are fixed expenses, and we'll take a look at all of those things. Variable expenses are labor, including your labor, and you always have to price in or cost in your labor, parts and supplies, inventory that you buy in order to sell. They're variable expenses because these expenses go up and down depending on revenue. So expenses are all the categories of costs that where your money goes out the door, as opposed to revenue where it comes in. Profit is what's left over after all the expenses are paid. And by the way, after you've paid yourself. Okay, so why bother with this? We're going to go through an hour's worth of looking at Excel spreadsheets and figuring out how the pieces all fit together. What's the point anyway? Well, it helps you figure out whether the business will enable you to reach your personal income goals. If you put together a projection and the amount of profit that comes out at the other end and the amount of money that you can pay yourself isn't enough to satisfy those personal income goals, probably shouldn't do it. You can help figure out how much money you'll need to start up or to expand. You get an understanding of the financial risks and rewards involved. You can identify the development and startup costs and the ongoing expenses separately. And startup costs are really important, as we'll see when we get into this. They give a funder, whether it's a family, a nonprofit lender, or a bank, the information they require to decide whether or not to give you some money. And lenders, except perhaps for family, but even family, are giving you money on the basis that they expect to get it back. And so you have to give them a projection that shows them and shows you that you can, a projection that you can defend, that shows them that they're likely to get their money back once the business gets off the ground. And finally, it provides a plan to help guide your decisions and monitor how you're doing. So, some common concerns when we look at financial projections templates. Ah, God, these things look so complicated. I don't think I can do this on my own. I don't understand all the figures and the math. Can I start my business without a financial projection model? Yeah, it's not a good idea. You really can do this, and if you need some help, SCORE mentors can help you do it. So follow along as best you can, and I think most of you will get this without any problem. If you're not familiar with Excel, there may be a couple of things that that are a little bit tough to grasp. Just ask a question in the Q&A, please, and we'll come back to all of those as either at the end or as we get to them in the presentation. So the example that we're going to use is Anne's Nursery. And Anne's Nursery produces specimen trees, shrubs, and vines. So not not the typically the flowers that you go out and buy at Home Depot, um, but rather the bigger things that you have to dig a hole to plant, a bigger hole to plant that lasts for years. And she's looking to have revenue, third year sales of $710,000. That's what she has decided she needs to have in order to meet her financial goals by the time she gets through 3 years of this. And we're just going to go through the first year, but you'll get a sense of how to build the second and third year out without much change really from what we do in the first year. And who does she sell to? She sells to both florists and landscapers and consumers. So she has a couple of different channels that she's going to make her sales through, and we'll again look at what she has to do from a projection perspective in figuring out how to sell through those channels and what the profit is going to be from each one. So we have 6 worksheets to go through, and they will all work in Excel. They work in Google Sheets. They'll work in Numbers, in Apple's Numbers product. This is done in Excel, but they're absolutely transferable from one to the other. And we're going to go through the required startup funds. We're going to talk about salaries and wages. We'll talk about fixed operating expenses. We'll do a projected sales forecast, and we're going to go through a couple of iterations of that because she has more than one class of product that she's selling. And then cash receipts and disbursements. It's one thing to say, well, this much money is going to come in and that much is going to go out. But one of the things you have to know is when it's going to come in so that you can meet your obligations for paying it out. So we'll look at how that works. Okay, let's talk about startup funds. Startup funds in this case are for a plant nursery, and that's a little bit more complicated business than some people might have because it involves some land. We have to have a place to grow the trees, the shrubs, and so forth. A building, there needs to be something there in order to handle the equipment and so forth that and the people for that matter that are working on that land. There are some leasehold improvements. Now that's a very typical category of startup expense. If you have any kind of physical presence, if you have a storefront, even if you don't have land and building, you're just renting something. If you're renting a storefront, it's very rare to be able to move into it without doing anything whatsoever to improve it, to make it suitable for your business. So there are leasehold improvements that Ann is going to have to make. She has equipment to buy, furniture and fixtures. She has a delivery vehicle to purchase. She may have some others, but the total amount of fixed assets, things that she's going to use over and over again that don't get used up in the first year, amount to $172,000. And then she's going to have some other expenses that are sort of 1 year or they're short-term expenses, but they're involved in getting herself started. So she'll have some prepaid insurance premiums. She'll have that is she has liability insurance and that she has to pay for at the beginning of the term of the policy. She'll have inventory. She needs to start off with something. She'll have some legal and accounting fees, maybe a utility deposit, some supplies, advertising and promotions. And in her business, she doesn't need anything in the way of licenses, but it's a category that you should be thinking about if you need any kind of license or permit. And you may have some other initial startup costs. And she wants to have $3,000 on hand in order to start the business. And so she needs a total of $41,800 from this section, the operating capital, in addition to the money she needs for fixed assets. So altogether, she needs $213,800, $172,000 fixed assets, $41,800 in operating capital. Now that's a fairly substantial investment, and a lot of you might be starting up with businesses where you need much, much less. But that's okay. Just Leave out some of the things that you don't need or all of the things that you don't need. Remember to include other things that you might need, like licensing or permits. And this model will work for you. So she needs $213,800. Where's she going to get it? Um, so we also want to look at labor, and so she's got this $172,000, and she has to, when she has this, her startup, she has that prepaid insurance premium, counting and so forth. She's not showing anything at all for pre-opening salaries and wages. Probably not a great idea. But okay, she's going to contribute her own labor to it basically before she opens the door. Um, if you have a situation where before you open, you have to pay somebody, then that line needs to be filled in and it goes into the total of operating capital that you need. Um, there's another thing over here that we want to take a look at. It's depreciation. And it's the fixed assets last for several years, but they don't last forever, at least from the perspective of how they're handled on your profit and loss statement. So real estate and buildings are depreciated. That is, you write off 1/20th of the value every year, which means that on your tax return, you can reduce your profit by 5% of that $30,000. And similarly, leasehold improvements are depreciated over 7 years and so forth. You can see vehicles over 5 years. And by the way, with the vehicle, you probably are going to have to replace it after 5 years. And the idea of depreciation is that you're setting aside money um, from your current profits to put into a reserve to replace the things that you're depreciating. And in fact, you might never have to replace the real estate or building, although you have to do maintenance work on it. You might have to make more leasehold improvements and so forth. But the main point of this is you're putting money out for your fixed assets. The way the Internal Revenue Service treats that expense is to say you can reduce your profit over a period of time for the fixed assets that you have acquired. You can reduce your profit this year, in the current year, for the operating capital that you put out, because that only lasts for a year. So depreciation is sometimes gets to be a bit of a mystery. We'll come back to it a little bit towards the end, but different classes of assets have different depreciation rates, and it's important to remember that. Land doesn't depreciate at all. Um, let's look at the operating expenses, both fixed and variable, for a single month, and we're going to look at the startup month of January. So she's got advertising to do. She has car and truck expenses, doesn't have any commissions or fees. Um, she doesn't have any contract labor, that is labor that's not included in her payroll. She has to pay for some insurance, legal and professional services. This is basically cash out the door, $4,300. And she has supplies. She's perhaps going to do some travel to vendors, utilities, and so forth. Um, those are the expenses that she's going to incur right as she gets started. Okay, so that's the expense part of things, the startup. That's the money that we need in order to get the business off the ground. The fixed expenses, the fixed assets, the operating assets that we're going to need in order to just do that first month's worth of business, and that should encompass in total the amount of money that you need to put into the business to get it going. Now, let's talk about sales and projection. We talked about what goes out the door first. Let's talk about what comes in the door second. It takes time, and this is a really important thing to recognize. It takes time to get that first sale. and more time to build up sales volume. So if you say to yourself, well, I want to be running a business that generates $200,000 worth of revenue. Well, let's take an easy number, $240,000 worth of revenue. That's $20,000 of revenue per month. But the chances are you're not going to get that $20,000 of revenue the first month you open the door. So you have to figure out how that is going to scale up. And at the end of the first year, you probably won't have $240,000 worth. You might, hopefully, in the second, but we're going to take a look at how Anne has gone through this in thinking about her three categories of products. She has to be realistic. She's going to ask some people who work in the same sort of business how long it took them to get started. And she's going to build a month-by-month sales projection. And we're going to go through that with her. She has these three types of sales: direct to local retailers, through representatives to distant retailers, and through internet-based sales to end consumers, where she ships something to a customer who orders it over the internet. And if you're familiar with landscaping over the businesses over the internet, there are several firms that sell everything from bulbs for tulips to small trees over the internet. And they figured out how to ship them. So that's a category that she can anticipate getting into. But the timing is going to be timing of her sales and her startup is going to vary with each type of these of customer. And by the way, in her business, there's a seasonality. So you have to do the same thing in your business. Is there a seasonality? Is Christmas a really busy season? Is July, August a really busy season? Springtime, when is your busy season? Or do you have one at all? And when you're thinking about your sales and how you start up your sales and the rate at which they'll build, you have to factor that seasonality in. So again, we've chosen the type of business that has this little complication of seasonality. Plus three different categories of sales channel. You may have a simpler situation, but if you have something that's as complicated as this, then here's a model you can use. Okay, so when you're thinking about this for yourself, what unit categories make sense for your business? Are you selling a product, something that you can pick up in your hands? Are you selling a service? And you're selling either by the hour or for a fixed price. That is, you charge if you are, for example, doing plumbing or electrical work, you're probably charging by the hour, but somebody might ask you for a fixed price for a particular scope of work. So services may depend on services may be sold based on either hours or a fixed price. Or you may have some combination of both products and services. So you want to determine what makes up your unit of sale and determine your direct cost, how much it costs you out of pocket per unit. And then from that, figure out what your price should be. And of course, your price has to it can't exceed what the market will bear. And we'll talk about that as we get just a little further into this. Okay. So she's got three product lines, and one of them is plant mix. And she's going to assume that over the year, that is a combination of plants that are sold in a bag. And over the year, she's going to sell 125 of those. In January, she's not going to sell 12 and a half of them. She's just getting started, and it's cold in that time of year, and there may be some retailers who are sort of stocking up and getting ready for spring. She figures she'll sell 6. The total sales for that product she expects to be $250,000. In January, 11,000. Her cost of goods sold, what she pays for this for this product is $137,500 or $6,050 a piece for this. There's got to be a pretty good size bag. It probably is something that occupies the best part of the truck. And This is what's left over. The total sales minus cost of goods sold gives the total operating margin. It's not her profit. Her operating expenses, the insurance costs, the telephone costs, all of the things that she has to pay for a month by month have to come out of that $4,950. So that again it's an important concept to grasp. What you're buying in order to sell doesn't give you just a total profit just by subtracting the cost from the sales price. You've got operating expenses that will come out of that margin, that operating margin, and we'll see how that works. So here indeed is how some of this works. This is complex, so let's take it one step at a time. Each product line has its own cost, its own margin, and its own seasonality. So remember, we've got these three product lines: the plant mix, the stuff that's sold over the web, and it's sold through a distributor to a distant nursery. And here's what the sales price is per unit. Here's what the cost of goods sold is. Here's what I have to pay for it. And this is my margin per unit. And this is a little bit different product. It's sold over the web. It's not sold in a truck. And so it's the sales price per unit is $100. Cost of goods sold is 60, and the operating margin is 40. And then she's selling to distant nurseries, and that's probably going to go by in a large shipment because it's going to a nursery and not an individual consumer. And that's $1,000. The cost of goods sold per unit, what she has to pay for it, is $600, and her operating margin is $400. Okay, so here we have what she expects to sell each month, and this goes back to what I was saying about seasonality and the amount of time that it takes to build up. So she feels like the plant mix is going to take off at the beginning in a fairly small way, but build up through the springtime, through May and June, and it reaches a peak. And then in July, it sags because both customers of the nurseries and the nursery companies themselves, people go on vacation. And so in August, she hopes that it will come back up to that same level of May and June, and September then tails off towards the end of the year. And that's probably a reasonable seasonality curve for what she's selling. So it yields sales of $10,000 in January, $40,000 in June, $250,000 at the end of the year. But very clearly, there's a big difference month to month from 10,000 to 40,000 and in fact, in the summer, she's expecting that big drop and then a return. So she has to think about scheduling how her costs are going to get paid and so forth out of that. But the cost of goods sold, of course, is what it costs her to bring that in. And let's make the assumption that she's paying for it in the month that she brings it in. And so this is her operating margin here. And so she's got $137,500 of out-of-pocket costs to support those sales. And then she's got an operating margin for her monthly operating costs or annual operating costs of $112,500. So let's look at the plant the same setup for the next category, the plant mix that's sold on the web. And she's figuring that it's going to take some time to attract people to her website, and it will get a little bump in May, and maybe June and July, she's figuring that it'll slow down a little bit. And then by September, October, November, when perhaps people are planting shrubs in the fall, she'll really get a peak, and then in December, it drops off sharply. So you have the same kind of calculation. Here's the sales based on the price. Here's the cost of goods sold. And here's the operating margin. And again, she has $22,800 left over for her regular operating costs. But the sales number at the beginning is a big hole there. It's a zero. And for distant nurseries where she's going to work through representatives, that's going to be a longer selling cycle. So it isn't really until the next year that she's going to see very much of that. So she's got 8 months worth of no sales here. And then she just begins to pick up. So very clearly, she's targeting $700,000 or $710,000 worth of sales once she gets going. But in the first year, it's only going to be about half of that. And that's very typical of a startup business. It takes time to get revved up, to attract some customers, to begin to build a reputation, to get some word of mouth, to have your advertising have effect. And this is what Anne sees in the course of the year. In the first month rather, she has an operating margin of only $4,500 to work with. And she's going to have expenses higher than that. So we'll see what the effect of that is. By the time she gets up to August, September, October, November, she's got much stronger margins. And again, that looks like it should be enough to support the monthly operating costs. But we'll prove it out. Okay, let's stop here for a moment and take a good look at this. I want to see what's, we don't have any questions directly about this.
I do have one question that got put into chat.
Yeah, I see that. Go ahead.
Oh, okay. Did you want me to read it, or do you
Yeah,
want to
sure.
wait?
Go ahead, Teresa.
Okay. In our example, she has one product across three sales channels. Do you think it's reasonable to plan more than one product at a time? Some number of related products, example, physical plus
Right.
optional service to help use it. Do you think those projections would all need to be done separately ahead of time?
Yes. Okay. So it's three sales channels, but the products are a little different for each one. Just take a look at the top of that, the sales unit per price, because they're different. It's a different quantity. It may be a bag, but it's a different quantity going out to the customer. So the prices are higher. So really, it's three channels, three different products for one for each channel. But the short answer to your question is, yeah. Yes, you should definitely do a projection based on each product and channel combination. So if you have multiple products, multiple channels, you need to figure it out by channel, by product. Now you can group products together that are similar, and that have similar cost structures. So if you're selling, let me think about this, shirts or sneakers, and they have roughly the same sort of the same sort of character in terms of what you're paying for them and the way in which you sell them, then you can group those together. But if you have things that are distinctly different, distinctly different costs, yes, you very definitely should try and separate them out. Okay. So let's again take a look at this and see what she's done along the lines of what we've just been talking about. She's got her three different channels. They are different, some of different products because they have different prices. And she's figured that out for each one of these in her mind. Now, this is a projection. This isn't actual sales, but it's what she's going to go with when she figures out how much money she needs to get started and what she's going to show to somebody who's going to lend her money, for example, to acquire that land. Okay. Where did she get this information? All right, so the unit cost and price she gets from suppliers, and you can also learn from competitors, particularly if you're just starting up in a business that's local. You can go and talk to other people who have local businesses in the same market. You may want to go out of town, not so far out of town that you're in a different place for a cost structure, but go out of town a bit so that if you're starting up a storefront or you're starting up a nursery business, you're talking to people who aren't going to be your direct competitors. But you can also talk to direct competitors. You can say, you may have worked in this field before. In fact, I kind of hope you have. And hopefully would have worked for a company in the nursery industry, and um, she knows some people in that business. She can talk with them and say, I'm going into business myself. I wonder if you can give me some pointers about how long it takes to get started. And sales volume and price, you can estimate this from news reports. How big are some of the other players in the field? You from work in the industry, as I said, from observing competitors. A trade association is a great way to learn about a business. So when you're starting a business, if you can join a trade association, usually that entry cost is not very high. You can get some good information and some contacts in the field. And so you have to estimate the sales volume needed to make the business profitable and see whether that makes sense to you. Does your estimate of what you need make sense based on what you're hearing from others in the market as to what they achieve? And you can get some pretty good help with um, news reports, information about the industry, what kind of trade associations there are, who's active in the industry. At the Boston Public Library, there's what's called the Kirstein Business Library or Business Section. It used to actually be a separate building. It's now in the public library building, the new part of the Boston Public Library that's accessible off of Boylston Street rather than the great big Greek temple that faces Copley Square. It's downstairs in that library, and there are reference librarians in there who can be an enormous help to you. And by the way, we have SCORE mentoring hours in that same location. So you can get two things done at once. If you go in there during public library hours and mentoring hours, talk to a reference librarian and talk to a mentor at the same time for the same parking meter fee. Okay, so those are some sources of information. Google is great, and you can start with that. And I noticed that some of you are using artificial intelligence applications in order to take a transcript. That's fine. But it's not just Google or Chat GPT. Go and talk to people in the industry, and go and talk to people who are in the industry broadly defined, suppliers, some customers, and get a sense of what's realistic in your business. Okay, some other inputs that we need to think about in a business are accounts receivable and accounts payable. Okay, so earlier I said that we were figuring, in fact, let's go back to it, that Ann was paying for this currently. That is, if she bought $5,500 worth of product, she had to pay for it in the same month. Once you get established in a business, you can probably get credit from your suppliers. That is, they'll give you 30 days or 60 days in which to pay the bill. And that can be very, very helpful. And by the way, some of your customers will expect exactly the same thing. So you have to balance off the credit that you get from your suppliers with the credit that you give to your customers. So let's take a look at that. Let's say that 30% of what you bring in has to be paid within 30 days, and another 30% within 30 to 60 days, and some of it more than 60 days, which is quite a long time. And this is your accounts receivable coming in from that is money coming in from your customers. So you're saying to your customers, I expect you to pay me in 30 to 60 days. Some of them will pay a little more quickly. Some of them will pay more slowly. Hopefully, you won't have any bad debt, that is, customers who don't pay you at all. It should add up to 100%, and that may be persistent all through the 3 years that you're operating. Your accounts payable, you may be able to get credit to pay everything between 30 and 60 days all the way through. Usually that won't happen. Usually in the beginning with a vendor, you'll have to pay right then and there when you're just starting up, although you may be able to get 30 days of leeway before you have to pay. And again, it should work out to 100%. And when we look at the cash flow in the business, the cash projection that we're going to end up with is this when we assemble all this stuff together, we're going to be thinking about, well, how fast do I have to pay my bills and how fast are people going to pay me? Okay, so if you're doing business totally over the web, you're buying things over the web or you're selling things over the web, um, you're typically getting paid with a credit card, and this doesn't apply. And there are other businesses where it may not apply, where it's pretty much a cash business. If you're a restaurant, food service, something of that sort, pizza parlor, you may be able to get some credit from your suppliers for the flour and the tomato sauce and so forth that go into your product, but you're going to get paid right away. And so think about the kind of business that you're in and what's the practice in that business. And again, you can find out about that practice by talking to people in the industry, by having worked in the industry. Those are the kinds of sources that you can get good, accurate information from. Okay, now let's talk about where Anne is getting her money. This is really important. Um, so um, she's putting in herself, she's saved up $115,000 of that $213,800 that we said right back at the beginning she needs to get started. Okay, so I'm going to go back to that just for a moment and remind you about where that came from. That was fixed assets that she needed to acquire in order to be in business, and $41,800 of operating capital, money that she needs in order to get started, to buy that inventory, which is the major piece of it, supplies for her office, do some advertising and promotions to get off the ground, $213,800. Okay, where's it coming from? She saved almost half of it over time. She doesn't have any outside investors. She has a commercial loan because she's got some collateral to put into the business. Um, and she's got a mortgage because she's buying land and a building. And she can get a mortgage from the bank because the bank will say, well, worst case, we'll lend a portion of the value of that asset. And worst case, if Ann can't pay us back over time, then we'll be able to get it back by selling the building ourselves. And similarly, she's going to get a vehicle loan because that's a relatively straightforward thing to get if you're buying a vehicle. And her total sources of funding have to be $213,800 is what she needs in order to get started. So she's got a match here. If she had more money saved, she might be able to get a smaller, or she would be able to get a smaller commercial loan or a smaller mortgage. If she didn't have quite that much, she might need to get more, and then she'd have to talk to the lenders to see whether they're comfortable lending her that additional money. And she's got to pay some interest on this. And here's the rate at which it's paid out. The commercial loan gets paid out over 7 years. The mortgage gets paid out over 20 years. And so this is what she needs in terms of monthly interest payments. And that's going to go into her great big cash flow. That's a monthly expense. It's going to come out of her operating margin. That's the money left over after she's paid for the product itself. Okay, for an existing business, this is the bucket of cash and receivables that are going to be turned into cash, minus what you have to pay out in cash during the year. So if you have an ongoing business, your funding is basically your cash in the bank plus receivables, and minus the amount of money that you're going to have to pay out in cash during the year. That's how much money you need in order to support the business. Okay, and there's a spreadsheet down here that will let you do that. Okay, now we're putting together the cash flow projection for Ann's business, and it comes out of what we've already done. Okay, so this is a 2-page spreadsheet, and we're going to show you the cash receipts and cash paid out The cash paid out is going to be in two chunks. So the cash receipts come right out of her sales projections. So you remember what those were? Let's go back and take a look at them. Here they are, and here are her sales projections. These are her monthly totals for each product line, and the cost of goods sold. And so that's her operating margin. Let's go back to the cash flow. Uh, Remember, she had cash on hand at the beginning for her operating expenses of $41,800. That's what she needed to pull together. This is we calculated that earlier. She's going to sell $10,000 worth of that plant mix. It's the only product category that she's got when she first starts up. So if you add the cash on hand plus the cash that comes in from that sale, it's $51,800. She's got a total of $13,500 going out for labor, including her labor and the employment taxes that she has to pay to the employees that she's picked up just for the three. She's going to mount up to three people by June. So that's the portion that comes off of the $51,000 of $51,800 for that month. For the next month, cash on hand. Well, let's go to the second sheet. Okay, so she's also going to pay all of these operating expenses, $4,300 worth of operating expenses, and that comes off of the rest of the operating expenses: commercial loan, the commercial mortgage, the vehicle loans, total other expenses. Here are all her other expenses. So her cash at the end is only $32,290 compared to the $41,800 she had at the beginning. So she's actually lost cash in that first month. And that's very typical of a business that's getting started. And so you have to make sure that when you start the business, you figure out what the cash flow is going to look like and make sure that you have enough money or can get enough money in advance to support that drain that's going to occur until you begin to bring cash in. And in Ann's business, you can see what happens. You can see that the cash at the end of each month goes down. It goes down pretty drastically until April, and then in May, it begins to pick back up. Springtime, she's made some progress with the second kind of class of product. She's selling more of the first class of product, the plant mixes, and so her sales pop up. Her expenses are relatively stable, and so her cash begins to build back up. So let's go back to the beginning, and we'll take a look at this month by month so that you get the concept. Okay, let's take a look at what happens here. Cash on hand is dropped down to $33,290 by the beginning of February. It drops again in March, drops again in April. Here it is in May. And then in May, she has a good chunk of sales, $40,000 in sales of this category and 5,000 here. And so, whoops, sorry. So she's got $62,112 to play with, and she's got payroll and taxes because she's had these people right along, and she's paying herself right along. And these are her expenses, and you can see that these are pretty fixed. Okay, these don't go up and down with revenue. It's the labor and the materials that go up and down with revenue typically, and in her case, she's not even varying labor. And her other expenses, again, these are fixed expenses. She's paying that commercial mortgage month by month. It gradually declines because she's paying off some of the loan costs. She's paying the commercial loan, gradually declines. Her vehicle loans, and she's got a line of credit that she's paying to the bank. And so that actually grows. All of her expenses pretty much stable. So the cash at the end dropped down to $15,000 in March, back up a little bit, in May, it really begins to look better. Back to the beginning. As you can see through the year, this all begins to look better and better as her cash on hand at the beginning of the month builds up. In August, it actually takes a drop because sales drop. And then in December, it's at its peak. And by the way, because sales will drop in December compared to the prior months, it will go down again in January of 23. So this is the whole, basically the whole ball of wax. Starting off with the fixed assets that we had to buy and the operating cash that we're going to need to get started, figuring that out at the very beginning, back here, and then going through all of the sales projections here and all of the expenses, and you get to the bottom line here, and you'll have in this month $161,800 worth of cash. That's pretty good. She can pay herself a pretty good bonus out of that, maybe even pay her employees a Christmas bonus. So it looks like she's okay. This projection is key. This kind of projection is key to starting any business. And if it doesn't look like it's going to be okay, if you don't have enough, can't figure out where you're going to get enough money to start the business, please don't. Figure that out first. That's the whole point of doing these projections. Okay. Figure out whether the business will enable you to reach your personal income goals. In Ann's case, she can. And figure out how much money you need to get to start up or to expand. And indeed, she's done that right from the beginning and figured out where that money is going to come from. So you want to give a funder, whether it's a family or a nonprofit lender or a bank, the information they require. And that cash flow projection is a very typical thing that a bank or a nonprofit lender will put into their loan application. You want to get an understanding of the financial risks and rewards. What are some of the risks here? Well, if it's a really rainy season, maybe she won't make those sales projections. Maybe it will take her longer than just the month of May to really get off the ground. She has to think about those things and consider whether the risks are reasonable to take based on the rewards that she thinks she can get out of this. You have to identify the development and startup costs as well as the ongoing expenses. If you're in an even more complex business than Ann is in, you may have some product development costs to go through, as well as the startup costs that we've talked about here. And you have to provide a plan to help guide your own decisions and monitor your results. So that cash flow projection is a great thing for her to look at month by month and see how she's doing. It provides sort of benchmarks for the end of each month. Have I got $83,000 in the bank at the end of August, or less, or more, which would be great. But I can make an adjustment. This is the spreadsheet that responds to whatever you put in it. If you need to make an adjustment, do that. And it will show you a different number for subsequent months, and that's fine. You can certainly make adjustments as you go along. But the key point is you want to use that plan to get yourself started and then to monitor the results, because it's not a plan that you just put on the shelf somewhere and never look at it again. It's a great guide to what you should be doing through the year as you're going forward. And by the way, some of your lenders will say, well, okay, I want to report every quarter, and you want to be able to give them a report that based on this projection and based on the actual results that you have. They'll make that same comparison. They'll say, well, how does she do in comparison to what she said she was going to do? Okay. Let's stop here and take some questions. So let's go back to the Q&A.
Yeah, we do have some questions. So for, we're gonna go back to when you were talking about labor costs for Ann's nursery.
Yep.
Were those labor costs averaged month over month? Even though her staff size was
Right.
going to be
So,
different?
yes, a good question. So what I've done is actually put three staff in there right along. And what you're really telling me is that I should make a change in that to do a projection that shows her building up in the number of employees. She might need three right from the beginning because she's got to get some plants in the ground and get some things organized and so forth. But probably she's building it up over some time.
And
Uh,
how might, oh, go ahead.
Right, well, go ahead,
Okay,
Teresa. Yeah,
if you have a service-based business and your cost of goods, could be like, for example, like construction materials for a project or something like that.
yeah,
How do you deal with it when those items are variable for every single project?
sure. Okay, so you need to figure out at the beginning, um, you need to figure out what you're likely to do in terms of sales of revenue coming in, and the so you have to take an average for projects that is based on your experience. And so if you, it's a very good question because if, for example, if you're an electrician or a plumber and you're doing a contract for an installation of some sort, as opposed to just fixing something, um, then each job has to be costed out individually. When you're doing your projections, you have to take an average of what jobs are. And the best way to know what that average should be is, quite honestly, to have done work like this for somebody else in the industry. But you can, talk to people who are in the business, get a sense from them as to what the average flow is. But then, as you're going through month by month, very clearly, when you're giving a price, you have to price it out for the amount of labor that's going into it and the amount of materials that are going into it on a job by job basis. There's some software for almost every industry, not terribly expensive software usually, that will help you do that. So whether you're a carpenter or some other building trade, something of that sort, there's certainly software for it. That's true as well for other kinds of service plus product businesses. Take a look at that software because it will give you a guide as to how to do this. Okay, hope that's an adequate answer. If it isn't, come back with another question.
Okay.
Um,
How, oh,
yeah, go ahead.
how much does, budget training inform the creation of the business plan?
So that's a great question. Um, the answer is that you need to do this as part of a business plan, and how you're going to get there is what the business plan is all about. And so it says, well, what's my market? How am I going to appeal to that market? What are my products going to be like? Why will I be successful in that market? And that's all sort of verbal. But then where the rubber meets the road is a projection, a financial projection, and it's a key part of what business plan should contain. In fact, to some extent, it is the heart of the business plan. Although how you're going to reach the customers and why they'll buy from you, you do have to describe that, absolutely. But in order to do the financial projection, you have to describe it to yourself. So the business plan in your head is what goes into the financial projection. Okay,
I
let's see what
just,
we have in the chat.
yeah, I
Uh,
just got a question about information on the first slide, but I'm not sure which
okay,
slide that
what was the
might
first
be.
slide is the question.
Yeah,
So
that's
you have
that is the big question.
the startup funds, perhaps that's
I
it.
don't know. They'll have
I
to
think
add
so.
to that.
Yeah.
Okay. I did just get another question about the availability of the materials. So we recorded today. That information will be available on the website in the next 24 to 48 hours. And you can find it on the score.org/Boston website under the local workshops previously recorded. I will be sending out a follow-up email with the Ann's nursery file because I guess must be some settings in Zoom that got changed that I didn't know about, so people weren't able to download that directly. So we will get that out to everyone that attended today as well. And I don't see, I haven't received a follow-up on the person asking about the first slide. But
Okay. Hopefully this is
I'm
it.
just gonna say, go ahead and reach out to me at my email address, and we can try and get that for you if we can get a little bit more explanation of what you're looking for. My email's outreach@scoreboston.org. Put that into,
And that's fine.
so you can let me know and I can get information to you as well. Okay, I think we're gonna wrap, and thank you everyone for joining us, and have a great rest of your week, and thanks, Mike.
Okay, thank you. Bye-bye.